Walmart announced their Q2 earnings before the bell today, and Wall Street and retailers are breathing a sigh of relief. We'll talk about some of the reasons why on today's show. What is going on, investors? Hopefully, guys are doing well out there. Time to talk about Walmart, which came out with their Q2 earnings before the bell, and Wall Street's loving it. This stock is up over 5%, nearly 6% during the regular trade. That's after Q2 revenues came in at $152.6 billion. That was 8.2% year-over-year growth, and it beat expectations on that revenue side by $2.64 billion. Wall Street was expecting growth of 7.2%. Walmart came in a full percentage point above that at 8.2%. Now, we also got Q3 outlook as well. That's incredibly rosy as well. Walmart expecting sales coming in at 5% growth. Wall Street was expecting 3.85% growth. So another full percentage, more than a full percentage point growth on that revenue for Q3. And then finally, we also got full year, essentially a fourth quarter read. Walmart expecting full year sales growth coming in at about 4.5% for the full year, essentially in line with expectations. Now, when I do look at these revenue estimates, when we start looking out into calendar year or fiscal year 2024 for Walmart, is the fact that Wall Street just has a 3% growth handle on this company. Certainly, we've seen in the most recent quarter and the upcoming 2 quarters for Walmart, it's looking like they're going to come well in excess of that. So it'll be interesting to see if analysts boost up these targets for next year, or if Walmart's set to really outperform those targets for the upcoming fiscal year. Now, Walmart is hoping that maybe they're going to be able to drive growth for their Walmart Plus subscription program, which is very similar to Amazon Prime, but they are not going to go the Amazon route, where Amazon, as you know, bought MGM Studios earlier this year and has obviously rolled that up into their Amazon Prime video streaming solution. Walmart's taking kind of the T-Mobile or the Verizon, if you will, route, where they're teaming up with a streamer, and in this case it's rumored to be Paramount Plus, which is its own ticker symbol of PARA. This stock, Paramount, actually popped on this news, which I think is for good reason. What Walmart's going to do is pay Paramount a wholesale price, so likely just a couple of dollars per subscriber, maybe even less than that, and bolt that onto their Walmart Plus subscription model. Now, I think this primarily is a hat tip to Amazon. I think if Amazon was not having success drawing members into a Prime membership, and then not only drawing them in, but actually keeping them there and allowing them to continue to renew, I think Walmart's seeing evidence that Amazon's investment and offering of a streaming video platform actually creates stickiness around Prime, and that's what Walmart is trying to do without the major, like, multi-billion-dollar investment. So I actually like both strategies. I don't think Walmart's core competency is similar to Amazon, and so I actually like Walmart's taking the partner route. I think it would be interesting if Walmart can roll in a few others. What if they could roll into a Netflix or a Disney Plus or something else into this offering? Could be a very, very competitive thing when you look at Prime, which is obviously more of a closed ecosystem on that streaming video side. Now, moving over to the Walmart numbers, this is what's important. We had those net sales come in at that $151 billion. We talked about how that was 8.2% growth year over year. Wall Street expecting just 7.1% growth. Now, year over year on a 6-month basis shows a little bit of a flattening trend. So this was an outstanding quarter for Walmart, and we can see why the stock is popping on these results. Now, we had some membership and other income as well, mostly coming from Sam's Club. That bolstered up by about 25% year over year, and we come down to a total revenue number here at about $152 billion. Now, we have costs and expenses as well. What we notice is those costs of sales, look, all that food inflation and cost inflation, that is just really driving up those costs at Walmart, and we see that exceeded our revenue growth of about 8%. Our cost of sales exceeded that to about a 10.1% growth. Now, what I think is really encouraging for Walmart is the fact that operating, selling, and general administrative expenses, those only climbed 5.8% from $28 billion up to about $30. So what that means, if inflation can come under control a little bit, that should start to flatten out our cost of sales increases. And if these operating costs remain about 5-6% growth, and we can couple that with stronger than expected expected revenue growth, well, our operating incomes to start to turn around. But in this most recent quarter, it went down because obviously when you grow your revenues by just 8.4%, but your total cost of those sales went up over 10%, and that's the bulk of the cost that Walmart realizes, well, your operating income is going to get hurt. In fact, it was down over 6.8% year over year, down from 7.3 to $6.8 billion. Now, we have some debt interest that we've got to pay, but that's actually down 9.6% year over year. We'll see this when we get to the balance sheet and cash flows. When you pull all the way down to a net income number, it's actually an improvement year over year based on some other gains, some other businesses that Walmart operates that's not necessarily related to the core Walmart and Sam's Club business. So from a net income perspective, $1.88 coming in over 23% on a diluted share basis year over year. These are strong results for Walmart based on the economic backdrop that this company is operating under. Now, we come down here to the balance sheet. Some interesting things here. We see our cash and cash equivalents at Walmart here went down from $22.8 billion. This was last year. Now we're down to about $14 billion. That's even down from the beginning of the year as well. Now, the all-important inventory line, this is what Wall Street, this is what most investors are starting to look at. Now, we noticed year over year, it's up dramatically from $47.7 billion worth of inventory last year, now all the way up to a number close to $60 billion. However, it's not up that much considering back in January, you had about $56.5 billion worth of inventory. That's after kind of a holiday season where you probably deplete a fair amount of inventory. You'd also expect in July, Walmart heading into a holiday season and where supply chains still remain a little bit disrupted, to say the least, well, they might be stacking or building inventory a little bit. Also, what we know is the CEO of Walmart, who I think is doing an outstanding job when you look at these numbers, when you look at the forward estimates coming over these, this is fantastic. We heard on the conference call, he's talking about how a lot of this inventory is based on food inflation. Food inflation is going up more rapidly than your hard goods inflation, and they are having to bring in food by the truckload every week. Obviously, some of it is perishable. And so the company is just having to pay an increased price to carry that inventory. That's where some of that inventory build is starting to show on this balance sheet. We'll see this level out likely if and when inflation starts to get tamped down a little bit here in the United States. Now, coming down to the liability side, interesting stuff. We had short-term borrowings really accelerate. My guess is maybe they took on maybe a line of credit to finance this inventory a little bit. They took on over $10.6 billion worth of short-term borrowings. Typically, that's some kind of line of credit. Now, they also had a long-term debt due within 1 year. That's coming in at $5.3 billion. That's way over 1.6 last year and 2.8 at the beginning of January. And then finally, you come down here to long-term debt. This is where when we saw on the operating side, the fact that your debt interest went from $437 million down to $395. One of the reasons why is you reduced your long-term debt. Last year, it was $39.5 billion. It's down nearly $10 billion to $29.8 billion. And even from the beginning of the year, it's down about $5 billion when it was sitting at $34 billion. So this company, especially when we come over here and look at cash flows, is trying to reduce that to a certain degree. Now, we pull down a number for cash flows, pull down this net income number, very much flat year over year, $7.1 billion last year, essentially 7.2, and essentially $7.3 billion worth of net income during the last 6 months of 2022. Now, we come all the way down to our net cash provided by our operating activities, and we see this is actually down quite a bit. So cash flows at Walmart year over year on a 6-month basis, actually down pretty significantly from $12.4 billion down to $9.2. Let's look at some of the reasons why. So they have some net unrealized gains or losses in this case on some equity investments that they've likely made. Last year was quite a bit higher at $3 billion. This year, just $2 billion. So that negatively impacts your bottom line when it comes to cash flows. Obviously, as well, we see inventory stacking. Last year was 2.7, this year 3.7. So both of those line items negatively impacted cash flows at Walmart in the most recent 6-month period. Now, we also have property, plant, and equipment went from $5 billion last year up to about 7.5. So an acceleration of that investment. And then we come down here to financing activities. A lot of interesting, not always this interesting when you look at Walmart. We have this net change in the short-term borrowings. That went up to $10.2 billion. We have repayments of long-term debt in the most recent 6-month period coming in at about $1.4 billion. They paid dividends to you, the shareholder, coming in at $3 billion. You notice year over year, it's actually down a little bit. Last year, they paid about $3.091 billion in dividends. Now they're paying $3.081. And so some of you might be wondering, well, why are they paying less on the dividend when the dividend is actually the same, if not higher this year? Well, that is because they are purchasing and buying back the stock of Walmart. So as you do a buyback at a company that pays dividend, you actually reduce the dividend liability because there's less shares to pay a dividend for. And so it's kind of actually a double whammy. You retire the shares, it helps EPS numbers, it helps certainly the stock price, certainly in the shorter term for most cases, but it also reduces your dividend liability. Obviously a rounding error when it comes to Walmart and most companies, but just something to think about when you see a buyback on a company that also pays a dividend. In terms of financing activities, we saw some cash burn there over the last 6 months. You burned through about $844 million worth of cash. Things are looking pretty good. These are not spectacular. Certainly from an operating cash flow perspective, the fact that our operating income as well declined, but it's pretty easy to excuse some of these things. And then when we start to look out into 2023, which is fiscal 2024 for Walmart, well, things get a little bit brighter because Wall Street has very low expectations from a revenue growth perspective. And if this company is able to come over and above that, probably at the very least will hold its valuation, if not go higher. Now, the thing is with Walmart, from a technical perspective, for 3 years, the stock has been in sideways consolidation. The bottom end of the zone is about 120. The high end of the zone is up here at about 150. That's a really tight range when we're talking about a stock this large. You notice over $150 per share has literally happened just for a couple of days, if not weeks, for this company over the last 3 years. We are sitting right now at about $140 per share. That is certainly towards the high end of the sideways consolidation we've made with Walmart. What we're expecting from a technical perspective is for this stock to potentially melt up into that 150 range. If momentum stays in these markets, we get positive reads from Walmart, certainly positive reads on inflation as well, certainly could benefit a Walmart. This one could push up to the high end of the range of 150. Maybe you get some momentum to push it up over 150, but that is where the sellers materialize. We would expect this stock to make a pullback at some point. There is an intermediate area where when this stock hits the 150 level, it likes to pull down here to about 135, which again, we're basically splitting hairs with Walmart. If you're in this one for the longer term and you believe they're going to start outpacing estimates for their revenue growth, inflation eventually gets tamped down, so these cost of sales don't rise as rapidly as our sales growth happens to do. Well, look, 140 long-term 10, 15-year investment. I don't have a problem. I wouldn't necessarily split hairs with this one. You're getting a buyback, you're getting a dividend as well. From a pure technical perspective, we need to get this one much closer to the bottom of the range, which would be down here at about $120, $125 per share. There also is a mega long-term uptrend with this, although these have been getting broken all the time this year. From a technical perspective, it's still pretty much intact. I have it here. I'll thicken this purple line with Walmart. This longer-term uptrend is quite frankly still intact. So a pullback technically to there as well could trigger a buying opportunity. I don't think I'd be aggressive with Walmart. If you're adding to a position, if you're starting one here, it would just be kind of a minor buy, because I'm just trying to think of some of the reasons why Walmart would all of a sudden just continue to accelerate to the upside, push over all-time highs, over 160, 180, 190 on a single-digit margin type company and low single-digit revenue growth. Unless this company can foresee a reason to really accelerate that, I don't see this one necessarily getting away from you. That's why I wouldn't necessarily be aggressive at this area. Walmart essentially fairly valued, but there was a lot of negative news priced in, some of it based on management commentary as the executive executives played a very cautious role when it came to guidance, when it came to forecasting. They obviously came in well over and above that. Some people might say they sandbagged a little bit. That's what has us interested in the upcoming 18 months, thinking that maybe Walmart will very much outperform those estimates. We'll certainly be here on the channel to cover it for you. Hopefully you guys enjoyed today's video. Back in soon with more. Good luck with your investments.